Hello, welcome everybody. Thanks for joining us today. We're super delighted to have Glenn back for a second time. Some of you may remember that if you were on the last call, we had actually met in another part of the world, not in New York, not in Toronto, not in Park City or Salt Lake. We were in Cayman Islands, and so we got to know each other and super happy to have him here with us today. Uh, Really a institutional real estate investment opportunity here. People say that, but you're going to find out if you haven't already done a little bit of research in the invitation and background that there's multiple thousands of units, rental units. This particular presentation today, aside from getting to know Glenn and his company, is to talk about what's happening in the UK and why they see an opportunity there and execute on it and raised a fair amount of capital already to do so. So thanks, Glenn, for doing this again. Super
Yeah,
appreciate it.
yeah, great to be here. Uh, Great to get to see people and hear from your listeners and talk about our story. So really glad to do that. So maybe I'll just start off, um, tell you a little bit about myself, and then I can talk about what we're doing up here in Toronto. So greetings from Toronto, Canada. No, it's not snowing here. We are in May, and it is getting nice outside, and it's warming up. All the snow is gone, um, and yes, we just went through an election process, so there was a lot of volatility. You probably heard a lot about Canada, particularly from your president, referring to us as the 51st state. So hopefully. That doesn't materialize and we remain a sovereign nation. So delighted to see everybody. So I'm the chief operating officer of Starlight. Starlight is a company that in its current form and in its predecessor form, has been around for over 30 years. It was founded by a gentleman that has history in Germany, originally from Berlin. In Berlin, the family started in the real estate business roughly, they just celebrated, I believe, 77 years. So if you could imagine, Arthur, they've been in business for about 77 years. So it's a multi generational business. And our founder, Daniel, came over in the early 90s to basically lay his stake in Canada. The family had some investments in Canada. He basically came over and then was running the family business up until a point where he took on third party capital, repatriated the original seed capital back to Europe, and then built his business. Um, just to give you a little sense of where we are today, I've been at the company about 8 years. When I joined the company as chief operating officer 8 years ago, I did my first town hall. And I remember I was talking to about 100 people, and we were managing 7 billion of real estate. And then you look 8 years later, and our most recent town hall that I just did in December at the end of the year, we were 400 people in a room. And today we're managing roughly 30 billion of assets under management. It's been an incredible growth story. Um, if I give you a couple of high level numbers, so in terms of our Canadian residential business, we call that multifamily business in Canada. We're the largest corporate property owner in Canada. I try to stay away from the word landlord, but we're the largest landlord in Canada. We own and manage roughly 55,000 apartment suites across Canada. 55,000. We're the largest. The number two would be a public company, one of that trades on the Toronto Exchange that manages and owns roughly 44,000. So we're number one by I would say a meaningful margin.
Yes.
And
And
and what
private.
and we're a private company.
Yeah.
That's true. Um, what's unique about us is, although we have partners that many of you on the call will have heard of, whether it's Blackstones of the world and the PSPs and the AIMCos of the world, um, you know, Future Fund of Australia, Koreans and the Chinese. Um, we invest in everything, so we are shoulder to shoulder equity investors alongside all our partners. And your listeners and your audience wouldn't be any different. What I'm going to talk to you about today is our opportunity in the UK, our second fund. This is about our second opportunity in the UK. We're investing also around 25 or 30 million pounds into that investment. In our first fund, which I'm going to talk about, we've invested also roughly 25 million pounds. So the takeaway is we invest shoulder to shoulder with our investors. We're not a fee player only. We're an LP, we're a GP, but we're shoulder to shoulder. So our Canadian business operates across all strategies from our value add. We do a core plus strategy, a core strategy, and a large development pipeline. So Canadian, we've got 55,000 apartment suites that we own and manage across Canada. We have a pipeline of just north of 20,000 sites for development across Canada over the next 10 years. And when you say, well, how do you have 20,000 sites? Is there that much available land for greenfield? You're right. That's a good thing to question, but they're mostly infill. About 85-90% are infill. So during the construction boom 50 years ago, when plots were handed out to developers and owners, they would give them with large plots of land. And what we've discovered that we would put up our building, and we have sort of superfluous and underutilized land on that site. There could be a single structure that's underutilized. It could be a parking pad that is just not needed because parking's underneath. So more often than not, of the 20,000 units, call it 85-90% of those are infill, where we already own the land. We have no land cost. We're just putting up additional density, either stacked townhouses, mid-rise, in some cases high-rise, on that same land. So that's how we're able to have a strong development pipeline. Our US business, we are in the US. So if you look us up online, you'll see that we have a large US presence. We have around 11,000 units in the Sun Belt and in the mountain region in the US. And you know what that is. That's three-story walk-up garden style. They typically are 300 to 450 units across a big campus. Very sophisticated business. We like that business, and we're doing well in that business. Primarily, I would say it's a core plus and core business for us in the U.S. We're in Sun Belt markets, which you're all familiar with, and it's a difficult market right now, as you would imagine.
So,
We
so
have a
why is it difficult?
I would say because over the last few years, there's been a lot of supply that has come onto the market, and it's created intense competition. So from the sort of market specific, just the additional inventory that's come on. So it loosens up some of that supply demand. It surpasses that point where it becomes advantageous to the property owner because there's just so much supply. But what's really been at play is where the underlying yields are. So when you look at the cost of financing, we're sitting now where you see where the treasuries are in the US, you put a lending spread on that, and then you look at where cap rates are, you've got negative leverage. So that's not a great thing. Now, you would say in a value add strategy, that could work. So for some of your listeners that participate on the value add end, that's not bad because you could be driving 20 to 50 beeps annually of expansion on your NOI over stabilized cost. And eventually you'll grow right through your cost of debt. That doesn't really happen on a core or core plus strategy.
Right.
So you end up getting upside down a little bit. And then when you start seeing rental growth rates that are flat to negative in some markets, you're just not getting the NOI lift that you need. So I think what will happen is as we get into 27, 28, you'll start to see some of the characteristics come back again where we were seeing positive trade outs, strong NOI growth, more like 21, 22 time, where we didn't have such a large supply coming on, and there was a reasonable amount of tightness in the market. So that's the issue. So that's our residential business in North America. We have a commercial business in Canada as well, which is about 7 million square feet. Primarily office. It's not industrial. It's office real estate. Difficult business for us. What sort of saved us a lot was that our tenants primarily are governments. So it's the Department of Agriculture, the Department of Corrections, any of these tax agencies, and they tend to pay. Whether they occupy or not, they're going to pay, and they sign long-term leases. So we've got an interesting concept on commercial as well. And then finally, what I'm here to talk to this illustrious group about today is our UK strategy, our UK business. And there's a real opportunity there. The way we see it, this is where Canada was 20 years ago, completely underserviced, unsophisticated, not institutionalized. That's where the opportunities are. So to, you know, take away some of the suspense, we are seeing returns in the 23, 24, 25% IRRs because A, we're buying in markets outside of London. B, we're buying at development discounts of like 100 to 150 basis points. Um, and we're growing the expected NOI greater than sort of where the market rent growth is well above what we're underwriting. And at the same time, you're benefiting from the price escalation in the cost. So by the time I'm going to talk about our strategy, by the time we're buying this thing on a forward purchase, you're getting it at a discount to replacement cost. So let's talk about our UK strategy. About 5 or 6 years ago, we said there's a real opportunity in the UK, and we identified that because we're so familiar with Canada, and the UK is a close proxy to Canada. And we discovered that the built to rent market, that's similar to what you people on the phone on the call might know as your purpose built rental. But built to rent is basically apartments. It's rental apartments. It's a very nascent market. You know, in a country of 69 million people, there's roughly 115,000 rental units. Let that sink in for a second. But you're saying, no, that's impossible, Ben. Not everybody owns. You're right. You're right. What they do have are what's called built to sell units. And these are people like everyday people that go into a development, buy 1 or 2 units or 3 units, and then rent them out like a condo, that they buy the condo and rent it out. That's a very unsophisticated business. What we discovered is that of the population that do that, roughly 90% of those owners own less than 10. So just imagine how
Oh, mom and
fragmented.
pop. Yeah. Yeah.
It's a complete mom and pop cottage industry where there's no amenities. The developers are not building these condos for renters. They're building them for end users. So as a renter, there's no real amenities in this. You're not having proper apartment living, if you call it, right? With co-working areas, gym facilities, green roofs, open air spaces, things like that. So we discovered a few years ago that there's a real opportunity there. And what we said was, well, we're not going to go into that market and take on all this development risk. So we said, well, why don't we leverage what we've done in Canada, not on the purchasing of income producing, but we have a strategy that we've done about 4 or 5 billion of this. We've done forward purchases where we basically contract with the developer and we say, okay, look, we're gonna basically contract today a price for your development in whatever 3 years or whenever it becomes substantially complete, and we strike a price today. But what it allows us, because of our expertise in development, in owning rental property, we ask the developer, allow us to sort of give you our input. Let us bring in our design specs. We're experts in this. Nobody in Canada does it better than we do, right? So that's what we did. We went to the UK and we said, well, let's try that. So we went out and we hired an ex-Brookfield Living guy who ran Brookfield's Living platform. And he's our guy in the UK. And he goes out and he builds a team. And we've got about 15 people on the ground now in the UK, in London. And we said, let's target markets outside of London. Let's target major regional markets: Manchester, Liverpool, Leeds, Slough, Ashford, places like that. And let's target the London commuter belt, because these are markets that are anywhere from 30 to 45 minutes into central London, where you're buying it at half of the price per foot of London and you're renting at a 50% discount at least to what you'd be paying in London, but you're 30 minutes by train into the city of London. So that's what we did. And we went out and we found developers, well-known developers, best-in-class home builders, developers. And we said, look, you're living in a world where you've got to sell out 50, 60, 70% of this project for you to get your construction financing locked in, to at least start recycling any capital. And then you got to start selling one by one.
Yeah.
So we said to the developers, what about this? Why don't we come in and we'll buy the whole scheme? We'll buy the whole scheme. You'll build it, and then we'll contract a price at today for what we're going to pay for it when it gets 95% complete.
And you've already done this, like you've demonstrated that this works, right?
Yeah, so we did that in our first fund. We raised 230 million pounds. We went out and we acquired about 1,800 units, beautiful assets, all brand new core stuff, gorgeous, gorgeous, gorgeous. What we discovered is that we were underwriting to, let's say, the 30-year average of 4% rental growth. But what we were seeing in comparable markets stabilized were like 12% in Manchester, 10% in Liverpool. So we were killing it in those markets on the rental growth side. What we were also doing was we were telling the developer, look, on a stabilized basis, we need to take on, we want to, because we're guaranteeing this for you, and we're allowing you to get paid all up front and then recycle, and you have fixed price, we want to have a discount for that. The days of you selling one by one are done. So we're in that world in the 150, 160 basis point discount. So for example, we're buying these assets at about 6.1%, 6.15%. Stabilized, as everybody knows on the call, is about 4.5, 4.3, 4.4. That's stabilized cap rates. Those are the yields.
Yeah.
We're buying it at about a 6.1.
Yeah.
That's our discount on the developer's yield, basically.
Yeah.
So when you combine that, what we're seeing is roughly returns of, call it 19 to 24% IRRs on those. And we do quarterly updates. So we've done that successfully. We've got about 1,800 units. We just topped off Liverpool. That's going to be coming online. We've already got one building online of about 200 units or 250 units. So it's happening. We've got Allsop and Savills as our property manager in the UK. And we've got all the top consultants that have acted as our monitors on these projects. So we did that fund, fully deployed, very successful. Returns have been amazing. We said, okay, well, on the back of that, we had a lot of sort of unsatisfied demand, if you will, on that first fund. And then we started seeing our name is now in the market. If you look us up, Starlight Investments UK, you'll start to see all this press on us because we're becoming like the largest built to rent owner suddenly in the UK, because I don't know anyone else that has like a pipeline of 4,000 units like we do. So
Well, and wasn't it also true that the uh, residential customers wanted to live in your units?
yeah, the thing is that what you're finding in those markets, because it's so unsophisticated, the developers that do condos, they don't pay attention to things like, where's the garbage room? Like we went to one developer and looked at his scheme, and he had, because we own so much real estate in Canada, we know how to cater the product to a renter.
Yeah.
We know how to optimize the quality of life of a renter. But we'll walk into a building or the scheme and we'll say, well, why did they put the garbage room at night to be taken out through the front lobby? You can't do stuff like
Yeah,
that.
right. Yeah.
The gym shouldn't be there's no ventilation. There should be windows in there.
Yeah.
Why don't you have green roofs? I mean, you have to comply with some sustainability. Why wouldn't there be a gym here? When you design sort of the layout of the units, the foyer, the security, the exit and the entrance, how you get into the garage, all those things. There's a real science to it. It's not just putting up a building. And because of our experience doing so much of it, we were able to communicate that with the developer, and they're open to it. So we went out and we said, okay, well, let's do this again. So that's what I'm talking to your audience about today. It's our second fund. We're raising between 400 million pounds and 500 million pounds. We're going to have a hard cap of 600. We're targeting 18 to 20% IRRs. It'll be a 5-year closed-end fund. So what's unique about this for your audience, though, Arthur, is that it's typical for a high net worth or a family office. This is perfect because it's a very steep J curve. So we expect to call the commitment that your audience makes, the majority of it will be done in year 3 and 4. So in years 1 and 2, you may only be called on, call it 10%, because we're required to put a 10% deposit. But then it gets constructed and the development risk is taken on by the developer. We don't take on any development risk. So cost overruns, delays, all that has penalties attached to it, but it's on the account of the developer. We've got our price. We've negotiated our fixed price. So what your audience will see is that in years 1 or 2, you may get called for 10%. You may get a little bit in year 3, and the majority comes at the end of year 3 and year 4. That will stabilize for a year, and then we exit in year 5. That's really the life cycle. So we're back ending most of the capital.
Yeah, super interesting. Hey, in the project that you have finished and fund the first fund, were the developers happy that they didn't get stuck with stuff that they would that gave them trouble and agonized about taking all the development risk? I mean, did they manage to eke it out in a way that they were happy to do it again with you?
Yeah, it's funny you say that because most of our developers are the repeat guys. It's the repeat customers because our name is now becoming so established, and our that they securitize it to get their financing because they know we're behind it. All
Right.
you have to do is look us up online and
Yeah.
you'll see the scale of our business. So yes, exactly. It allows them to basically securitize to some degree and obtain their construction financing. They go to the bank and say, we've got all the units already sold. What it allows them to do is more expeditiously recycle the cash and start expanding their portfolio and putting deposits on other
Yeah,
sites
certainty
and
of
engaging other
close
sites.
is worth a lot to
It's worth a
everybody.
lot.
The
And
lender.
remember,
Yeah, yeah,
and remember, they're used to being in the one-off business
yeah.
where they're selling one at a time. We're coming in and we're taking 247 units in at once. So for your audience, when you're saying, okay, well, how do you mitigate risk here? Well, that's a great question. So what we're doing is we went out on our balance sheet for Fund II, which we're raising now. Incidentally, we're raising 400 to 500 million. The book today sits in and around 250. So we're if you look at 400, we're well over halfway there.
Yeah.
But I'll tell you why. When you say, well, why is this so attractive? Because of our scale, as you know, we can do things that many can't in that market. So we started accumulating what's called a seed portfolio. So from an investor standpoint, we already own 1,541 units that are going to be constructed that we're going to roll into the fund at cost. So you're not coming into a blind pool. On day one, when we close this on June 30th, right? You already own 1,541 units. That's roughly 50% of the target equity, roughly. That just incidentally, we just had an appraisal done on those 1,541 units on the land, et cetera. And it was reappraised at $22 million above what we paid for it. So that $22 million gain on the value of that land, effectively, on the appraisal of that land, is coming in at cost. So you're in the money on day one. Now, you're like, oh, I don't believe it. We do that. We've done that in our Canadian strategies on our funds, our commingled funds, where we'll house a seed portfolio, raise the capital, and we vend in at cost. So you're getting that free option, you're getting that
Getting
upside. You're in
a,
the money on day
a
one.
bump right out of the gate.
You're getting a bump right out of the gate.
Yeah.
Yeah.
And does that reflect, so in your example, 22 million, what's that as a percentage over and above what you paid for? Is that 5%, 10%, 22 million of
Yeah. So I'll tell you. I'll tell you exactly.
about.
Yeah.
Don't go
So,
crazy. Yeah.
so I'll tell you. So the 541 units are represent. Let's just use a round number of 500 million. So yeah, it's roughly 4.5%.
Yeah. Yeah.
Yeah. So we're in the money already around 4.5% on day one. You get rolled in at cost, and everything is in the data room. You can see what we paid, all the purchase and sale, and heads of terms and exchange documents. Everything's there, and basically that's one element. So but so that's 1,541 units. that's roughly half the equity. The other equity is going to go purchase through deals that we're going to be signing, and we've got a pipeline of, let's say, 4,000 units. So as we sit today, our UK business, we're under development on about 3,800 units.
Yeah.
So it's a big business. And the purpose of this is to try and get some interest from your US investors that want to participate in the UK built to rent space.
So
Now,
is it a, I'm sorry, Glenn. So let's talk about structure. It's a fund, so it's got, management fees and upside and GPLP type arrangement with a call of capital as you've described. So it's
yeah.
basically yeah. Is there a
So
pref or
typically,
anything like that or
no,
yeah,
it's very real estate deals like this are we never incorporate those type of wonky structures. What we
yeah,
typically do is it's a GPLP. The asset management fees, I would say, are quite light. It's typically depending on it could either be depending on the size of the ticket. It's either 100 basis points on the invested capital, not on the committed, but on what's invested.
yeah,
So if you come in at a big ticket, it's 100 basis points. Smaller ticket, it's 150 basis points.
yeah,
And then the other is a performance fee. And those, will set a hurdle rate of 8 or 9%. And then depending on it could be 20 for the manager, could be 25 over 9,
yeah,
20 over 9, that kind of
yeah,
thing.
yeah,
So
got it. Pretty
it's
simple.
no there's no capex fee, leasing fees,
Yeah,
lease up fees. There's none of that.
yeah,
Um, and that's, I mean, the real the real way we tell people is that we want to outperform. So the 100 basis points is just to keep the team on the ground managing everything to the best of their ability. But there's no other hidden fees, and then the performance fees are just it's in the data room, but it's typical waterfall economics that you'll see. It's not
yeah,
egregious,
yeah.
but that's how we typically do it on our structures.
Nice.
Yeah.
Yeah,
Um, when you think about the UK market, it's very interesting because we're seeing a lot of the dynamics across our platform in Canada in terms of the dislocation between supply and demand. So there's very strong demand resulting from strong immigration and the inability to carry the cost of owning a home, as you can imagine, right? It's funny. We were looking at different markets. One of the things I didn't open up with is yes. So we've got offices in Canada. We're in West Coast and East Coast. We've got an office in the UK, and now we're looking at Spain. So we're starting an expansion into Europe. Um, but we're very familiar with the dynamics in the housing market globally. This supply demand economics. Very strong demand coming from immigration, very strong demand coming from carrying costs of a home, very strong demand from overall finance costs, insurance, maintenance, everything about owning a home relative to renting. So this is no different. We understand that it's a really opportune time to be in this. When you talk about, who else is going here, I would say in the last year, you had about 8.1 billion pounds of equity that went into the UK BTR market. Now, you're saying, okay, well, Glenn, that creates tremendous competition. And these are names you would all know, right? It's Oxford and it's Landlease and it's BlackRock and I'm just looking NFU and it's Electra, CPP, they're all there. 8.1 billion last year. So you're saying, well, what does that do for you? It doesn't impact us because they're going in on what's called forward funding. So they're taking on full development risk with the developer and they're funding the development. We're not doing that with our investors. We're doing forward purchase. Why aren't they in the forward purchase business? Because they haven't done, they don't have a development pipeline of 20,000 units. They haven't done 5 billion of forward purchases. We have. So we've got an algorithm and a formula for how we design these schemes. So we go into the developer in the UK and we say, look, we're not going to be like a typical developer or a partner that comes in, 6 months before you're done to make final touches. We're in very early. We're designing the scheme with the developer in the UK. We're really making it incredibly nice product. I want to give you an idea. I'm going to call something up here for a moment. I'm going to give you a sense of what the product looks like. So let
Would
me see.
there, is it fair to say the other reason why the others that are bringing capital into the marketplace that are willing to take development risk is because they're just not willing to leave money on the table and take the risk associated with it?
Yeah, it's funny you say that because I think over time, if so, when we're seeing, I'm gonna answer that,
Yeah.
and I want to show you something. Let me just show you. Can you guys see this? Can you see this on your
Yep, yeah, I
screen?
can see it. Yep.
So this is our first fund. Okay, this is fully deployed. We raised 260 million pounds. We have about 1,800 suites, 550 gross asset value. So as of Q4 2024, so that's whatever. That's the last time we did it.
That's
we
crazy.
were at, we were at
24.9.
25%.
Yeah.
But you got to look at some of these assets. Like these are gorgeous assets, right? This is what we're developing. Okay. But here's what's interesting. I wanted to show you something. So when you ask me on something like this is central London in the middle. These are how the economics work, right? Um, you know, you're buying these on a forward basis at like a 50 basis point discount. That's what we get in Canada.
Yeah.
In our markets, we're sort of in the 180 or 140, depending whether you're in the London commuter belt. We're buying these at half of what they cost in London, right? But we're seeing 10% and 12% market growth when we're underwriting 4.
Yeah.
That's how we're seeing 19, 20%.
Yeah.
But here's something interesting. I wonder if I have something for you here. I want to show you something interesting. Um, let me see if I have it here. You'll just bear with me a sec.
Take your time. Yeah.
Uh, no, I don't know if that's here. No. Okay. I had a slide that basically looks at how sensitive the returns are to slight changes in rents or rental growth. And we discovered that like a simple, 50 basis point increase in the rent growth rate. So if it's not at 4, but it's 4.5, could drive another 100 basis points in my return. So just like that, I go from 19 to
8 to
20,
20.
21, 22, right?
Yeah.
But I want to get back to your other question. The developers that we're seeing now, they're not used to dealing on these cap rates. They're not used to that. They don't speak returns. They're talking price per foot. Am I selling at a price per foot, et cetera? But I don't think that's going to be like this in 3-4 years.
Yeah.
So the returns that we're seeing of 20, when I show you 24% on our like this 24% on our fund one,
Yeah.
if I think in 3-4 years that'll be more like 17,
Yeah. It's going to
16.
compress. Yeah.
It's going to compress
Yeah.
because the developers are going to say, wait a second, I want to, why am I selling this at 184% discount? He
Yeah.
knows stabilized 4.5,
Yeah.
but we're paying 6.4.
Yeah.
Okay. Um, these were in fund one. The 1,541 units in fund two, we paid about a 6.1 implied cap rate. So you could start to see a little bit of that now, right? The
Yeah.
spread might not be 184 basis points. It
Yeah.
might be 160. And I think over the years, that's going to compress. So that's why we're seeing so much take up because it's a vintage opportunity to get into the UK. You can, like because of what we're seeing in terms of, you know,
Yeah.
the
Rental demand, right? So,
yeah,
yep.
yeah. Like if you look here, you've all seen these statistics. Like go look at any major market, you're going to see this type of dichotomy where you're seeing very, very strong population growth. The government has this target to deliver 300,000 homes a year. They're not even getting to half of that. And if you look over the last few years, it's coming down.
Yeah.
So there's so much tightness. There's such a dislocation in the market between supply and demand. When you look at home ownership, look how much higher home ownership has gotten in the last 4 years, right? That's like almost 45% higher. Like it's just a fortune. When you look at your carrying costs, renting is under 30%. This is creeping up to like 45, 50%. It's less expensive to rent.
Yeah.
And then more importantly, when you look at the right, so that's your demand driver. When you look at the right, you see the shortfall in
Number of units.
supply.
Yeah. Yeah.
we're almost a million units short in satisfying that. So you're not going to hit any sense of equilibrium. And that's why we're seeing in the units that we're bringing online, we're hitting or exceeding our underwriting targets on leasing because there's just no supply. So, you know, I would say that's the opportunity today for your investors. Um, we're really good at this strategy. We've done a lot of it in Canada. We've done it in the US. We've structured this to mitigate a lot of risk. When you look at we do an initial deposit of 7.5%, and then basically the majority of the equity is due in 3 to 4 years. It's a very steep J curve. So your investors make a commitment. We call maybe 10% in year 0 to 1. We'd leave you alone in year 2 to 3.5, and then at the end we call the rest of the capital, and then we exit in
So
year 5.
the reason why you can leave the investor alone is because the developer has got the construction loan and financing the construction on that, and you don't have to pay. You've paid them a down payment on the forward purchase, but it doesn't even come close to what you have to close for in the year 3 and 4, right?
Correct, correct. And remember, we're a large organization, so we get involved in the leasing. We are very active now in the UK in terms of our lease ups. We've got a very sophisticated leasing platform here. You could just imagine with 55,000 units,
Yeah, totally.
what
What
kind of leasing program.
what's the regulatory sentiment there for, you know, leasing? I imagine if it's a new building, then is there a requirement to have l low rent and so many units that are for underprivileged or whatever the proper
You
term
know,
is?
Look, the truth is, the way we describe that product is attainable because if you look at sort of where average incomes are, let me share this once again. I think you should be able to see this. If I go here, right,
Yeah,
you're talking central London of almost £3,500 a month.
yeah,
Okay. We're like less than half of that.
yeah,
So these are very attainable. So you're earning London incomes, but you're living, I'll show you, where is it? I've got a really good slide in here. Yeah. So, we have an asset in Dartford and Ashford. I mean, it's a 1.9 million population. You're 42 minutes commute right into central London, and you're 53% less expensive on the rent,
crazy. Yeah,
right? We have an asset we just signed in Basildon, right here in Essex. 37 minutes, you're into Liverpool Street, and you're 50% on the rent.
yeah,
So you're earning London salaries, you're paying half. So they're very attainable. They're very attainable rents.
yeah,
We're looking at an asset now we probably signed on Milton Keyes. You're 36-minute into King's Cross. You're 42% less expensive on the rent. That's our strategy. So high population growth, strong rental growth, and good intermarket migration. So look at some of these. So in our target markets, we're dwarfing sort of where central London is on population growth, on employment growth, on rent growth, and rental. In London, it's like almost 50% of your income. You're dealing with tenants paying 2 to 1, income coverage of 2 to 1. Here, you're like 4 or 5 to 1.
yeah. Wow.
So I just want to see if there's anything else. You know, yeah. So we've done 5 billion of forward purchases. We're the guys. We know what we're doing. We've done about 9,000 suites through the forward purchase strategy. We've realized on exits of about 28% IRR. So with almost a two-time MOIC. So we know what we're doing. We've got about 11 or 12 people on the ground there. Same senior team out of Toronto that's managing that platform. The other thing we do is you're like, well, it's so far away. How are you ensuring that they're following your strategy? Because we went out and we hired all these consultants here. They work for us, not the developer, and they oversee everything: designers, architects, mechanical engineers, structural engineers. So we're monitoring everything. We have our own consultant base in the UK that's overseeing every single development
Nice. Yeah.
on our behalf. High amenities, gyms, very high finishes. It's very quality. This is an example of yeah. Typically, you invest $1 million, you'll get 40% in year 0 to 3, and then 60% in the final year. This is our pipeline of about 3,500 suites in different markets. This is the seed portfolio. For Fund 2, your investors would be owning this 1,541 units. Two of them are in Manchester. One of them is in Basildon in the London commuter belt. Uh, Large buildings, gross levered IRR today of about 20%. And these are $22 million in the money today. They're going to be rolled in at cost. So investors will be in the money. This is what they look like.
So, for example, when will the Basildon be done?
3 years.
Yeah.
Yeah. So deposits gone in, and now the developer is off and running. We monitor our team. We have 15 people there, right? So our people are all over this. They're on the developers. We're like this with the developers every day, and they're out to the sites every day. At the same time, I've got asset managers there. I've got property managers there. We've got few in lease up, um, and it's just delivering as expected, right?
Yeah.
So, so this is really the opportunity for your audience. Um, I would invite anyone on the call, have a look at who we are. Type us into the internet and see how large we are in Canada. We know what we're doing. We're the biggest. Our partners are global. When I think about our business, we used to always tell everyone we were like, 60% or 70% domestic investors and 30% global. We're now like 60% global, 40% domestic. We've got partners all over the world that want exposure to Canada, the UK, the US. So would love to bring in some US investors. I love this idea of meeting your network, Arthur. I think this is really cool. And I invite your investors to try us on,
Yeah.
have a look at us.
This has been super
We,
helpful. What's
yeah,
the uh, path for the company? Is it going to go public? Are you guys going to stay private? Is it something
yeah.
you can talk about? Does it really matter?
No, we're a private company. We're a private company,
Yeah.
and it's owned by one person in Toronto. And But we have some public funds, so we have multiple joint ventures, and then we have multiple commingled strategies and commingled funds. The commingled funds, you come in, it's like private equity. It's typically 5-year closed-end funds, and then we'll do an exit.
Yeah.
And the exit is typically to a large pension fund, a global player. I don't know if everyone on the call just saw, but GIC out of Singapore just came into Canada with $4 billion in the multi-res space. You can only imagine what's going on in our shop today.
Yeah. Yeah. Everybody's one. Which one of these are we going to sell? Right.
Like, well, you can only imagine because we're also raising capital for a Canadian strategy. It'll be our fourth fund in Canada. Our last was 1.2 billion. We're closing this in August. Our book is already at about 900. So
Wow.
don't ask. It's just it validates the thesis for residential real estate. What we see is this opportunity in the UK. We like it in a big way. We're putting in 25 million pounds.
Yeah.
So we're shoulder to shoulder with your investors on the call. If you think that we go to sleep at night not thinking about this, we think about it every day. I personally am involved and invested in all this stuff.
Yeah.
So we're all in it, and we
For,
want to succeed.
for the UK, is there a structure, being that it's UK and being that it's structured as a fund, to accommodate a 1031 exchange from a US investor?
So
It's sounds a
yeah,
little
so
complicated.
right now the way we've got the structure, we're working with KPMG to make it as tax efficient as possible. What we've contemplated is investors coming into a Jersey LP, and we don't know. What we're thinking of doing is a US feeder into the Jersey or maybe in Cayman, and then you would go into the different topcos, the UK REITs, and all the way down. So we have KPMG. It depends on what your audience and investors want to do, but we're very accommodating in that. We don't let the tax is an issue for everybody,
Yeah.
but like we've got multiple structures that we're contemplating, and KPMG is advising us on designing the most optimal structure. So if you ask, just to get back to your question, what do I see happening? Let's say your investors come into this fund, they're sitting there, they got the J curve, so you could commit X. We're not going to, you're going to do a 10% deposit, and then we'll call some capital, 30-40% in the first 3 years, and we'll see you mostly at the back end. You'll exit most likely in year 5 or 6, right? We'll stabilize, and then we'll start the exit process. We really know who the buyer is of this. This is most likely going to be large global insurers and pension funds wanting core product.
Yeah.
I mean, so it's a no, that's who's, you saw 8 billion that's coming in. That's someone on that sheet's probably the guy.
Yeah. Yeah.
So
Nice
we're,
stabilize that at with a 4.5% cap rate. Just put it into the portfolio. Make sure the
yeah,
pensioners have their money. I get
yeah,
it. Yeah.
yeah. And then if you look on the next buyer analysis, they see how sensitive the leverage is that you can grow, because these things are all being underwritten to 30-year rental growth rates, and they're kicking out multiples of that. So we're really bullish on this. Love to get some of your clients and your friends into this, and I do say that, when I sit with investors, I'm funny. I probably shouldn't say this, but I don't put any pressure. I just say, try us out. Like, you're not going to get hurt. You're going to do really great, and you'll get to know us because we're growing. We're global. We're 30 billion in AUM. We have some of the largest pensions and partners in the world that are investors with us. And it's great that you're doing this, Arthur, because you're allowing your network to have institutional access that they wouldn't otherwise have. And just for anecdotally, for your friends on the phone, um, our average ticket on what we've raised to date is between 20 million and 40 million. So, you guys have access, for $1 million or whatever, a couple $1 million, and you're in this thing.
Yeah.
So you're going to be shoulder to shoulder with the guy who wrote a 40 million pound ticket, and you could be there for £1 million ticket.
Yeah.
So, and that £1 million ticket may only cost you like 100 grand or 200 grand for the first 3 years.
I know, right? Yeah.
So, but again, I'm not a hard sell guy. So I think it makes complete sense. Would love to build relationships with your network. Try us out. You won't get hurt, and you'll see what we're doing at Starlight. Just check us out online. Read about us. We're the real deal.
Yeah. Totally impressive. Yeah. This has
Thanks,
been
man.
super helpful once again. Really appreciate it.
Great.
Glenn, yeah, really, really helpful and nicely done. We'll make sure
And
everybody can get in touch with you.
yeah, and if they want, how to get in touch with me.
Yeah.
I'm delighted to take calls separately. And I'm assuming there's no questions. Otherwise, you probably would have stopped me.
I no, I gave you all the ones along the way that came in.
Okay,
Yeah.
great.
Yeah.
All right.
So
So, Arthur, thank you so much. This is
you're
such a
welcome.
delight. Great seeing you. And I look forward to continued conversations, man.
Uh, let's go somewhere warm and have a drink. Okay.
Yes, exactly. All the best, everybody.
Thank you. Thank you, everybody.
Bye bye.